roller coaster. All right, enough with Facebook Marketplace. Let's get into personal finance lesson number 5, which is that if you invest for more than 20 years, it should typically yield positively. In the infamous blog post from the website of Dollars and Data, there's a really strong argument as to why the retail investor should stay invested over a long period of time. He points out that as stocks get more expensive, so he's using the PE ratio to gauge whether a stock is expensive or not, but essentially as the PE ratio goes up, their future returns generally decrease. And this kind of makes sense. Like if you buy an overvalued stock, it probably won't return as high as if you bought an undervalued stock. And you can see here that as PE ratios increase, so as stocks get more expensive, there's a negative correlation here with your returns for the next 5 years. There are more red dots in the 30 to 40 PE range than the 10 to 20 range, so red represents a negative return for the next 5 years. But the fascinating thing here is that as long as you hold for a longer period of time, you can see that as the years pass by, 5, 10, 15, 20, 25, etc., the number of red dots slowly decreases. The author states that, quote, over any 20-year period, US stocks have had no real negative returns when including dividends, and over a 30-year period, the returns have generally converged despite some dispersion. So he's basically telling us that if we want to accumulate our wealth no matter what, we should just keep buying into the stock market. As long as our holding period can be longer than 20 years, it's unlikely that we're going to lose money. Oftentimes, people think that the stock market is overvalued and then they end up not investing into the market at all. The author used a really excellent example to drive this home in his blog post. So for example, if you search stock market overvalued 2012 and you put that into Google, there are many articles that will come up detailing what investors believed at the time, which was that the market was overpriced by 50%. But if you look at this graph from the S&P in 2012, it was trading for around the 1400-ish levels. And if you had believed it was overpriced back then, you would have missed out on some serious gains over the